Good morning, ladies and gentlemen. This is Clueless 8, and this is the pre-market AM report, post-Fed meeting day for Thursday, January 28, 2016. I want to show you something very quickly, which will keep the bigger picture in perspective and hopefully guide us in a more productive fashion going forward. Observation number one, we're dealing with an extremely volatile market. Cross currents on the global macro currency fronts, oil, central bank actions, all are taking a larger role in intraday market movements. Large cap, high beta momentum stocks, the Amazons, the Teslas, the Googles of the world, are being swept around on the waves, down 20 one day, up 20 the next day, but all within a very structured trading band that I have constantly shown in all my charts. It is imperative and mandatory that every single member and free trial subscriber who joins my service review and study at least for a couple of minutes every single day, every single post that's put out on Twitter. The charts, the Clueless 8 trading charts, are very precise. My all the different indicators and lines, trend lines and such that I draw upon the basic charts are very accurate. Time has proven that. You guys have seen it repeatedly. I cannot tell you exact time frame, whether it's going to be 24 hours or 48 hours or 2 days, but I do know that when I back tested my work over a good number of years, it's pretty obvious that and clear that my targets are reached more often than not. Trade management is key. That's something you'll have to do on your own. Keep in mind, and I want to make this very clear, that market volatility will move prices around for no reason other than the fact that the algorithmic high-frequency trading programs that dominate the market will move things around at random. Despite that, we have had huge successes, not to mention last night's. Every single one of the almost every single one of the ER plays have generated substantial profits. And it's not just a one-day phenomenon. This has been occurring for a while now, given what I've delivered in content. So to repeat, I have no problem addressing any questions as humanly possible during the day, but I cannot answer questions when you all don't do your basic homework of looking and studying my work. People who are more focused, disciplined, more serious about the trading business and the investing business, it's almost imperative that you join the group coaching sessions. I have purposely kept my monthly rates down for my service, as well as minimal rates for these coaching sessions, which, honestly speaking, are tremendous. Everyone who's taken it on a consistent basis has seen the results in their own portfolios. The testimonials themselves prove, and you can talk to them directly. You can PM them during on the website, on the chat room. So it is imperative that you all also take one step forward so you can maximize the potential of the Clueless 8 trading charts without having to constantly keep on asking the same basic questions that have been answered hundreds of times. I produce a significant number of videocasts, including this, Periscope broadcast, tactical charts, breaking news analysis, and a constant engagement with my members and free trial subscribers that no other service out there has this level of contact with their members. So saying all that, do what you need to do, but you need to take that step forward because like they say, you can take a horse to the watering hole, but you can't make it drink, right? So ask yourself, what do you want to do? Saying all that, let's take a look at the macro picture of the S&P minis, which are obviously the backstage where the real action happens. And this is what we're seeing. This goes back all the way to November of 2015. We have a large macro falling wedge. This was the big 2,000 plus point crash. We have a very large reversal candle. You can see that. And this is where we are right now. Remember, volatility entails that these candles stay within a range. The range we're looking at right now, and as you can clearly see, we're back in that channel. The range we're looking at right now is around 18, I would say around 1840. And on the upper end, we're looking at around 1910 or so. This is the range that the volatility, what I call the volatility cluster. I've also shown some very tactical, repeatedly shown some very tactical charts going back to last August and last September when we had the flash crash, a retest, almost a retest of the flash crash. And it's the same volatility cluster that we encounter. My last video cast clearly talks about that on the Sunday night end of the week report. Saying all that, this is the trading band that we are following. If we break below the 1840 level, I believe we're going to come down and test 1800, which should, given where we are right now, act as a strong support. If we break 1800, bets are off. We're obviously going to fall lower. So this is the trading band that we're moving in right now. There's nothing to be amazed at, nothing to like, oh my God, there's Armageddon coming. The bottom line is that that's just the nature of the beast. So at this point, if we look at this channel here, we are within the channel again. And if we stay within this channel, there's a very good possibility, I would say it's 60% to 70% probability that we're going to hit the upper end of the channel, which is around 1936, translates into about 1943 or so on the S&P 500. Keep in mind, these are the E-minis, the S&P 500 futures. So this is the level that I've constantly shown as where the market wants to go. I believe, in my estimation, that this is where we will be sometime by the first week of February, going into next week or so. Okay, 1950. That's about 50. That's about 80 points, 70 points, let's say. So roughly about 400 Dow points that we're talking about. So we're back to about 16,300 or so on the Dow Jones Industrial Average. That's my forecast. Now, saying all that, you can clearly see here that when you look at the bigger picture, there hasn't been any significant damage. Significant damage, I consider, are candles like this. It's pretty obvious, right? I'm not the greatest candle reader, but my experience has taught me how to read them pretty well. So this is so these. If we get one, if we get one of these, we're going to hit 1800 real fast. Now keep in mind that's about 70 points from here. Again, that's another 400 points down that we're talking about. Is it possible? Anything is possible. We're in the heart of earnings season. We're starting to get the numbers. Overall, the numbers have been okay. They haven't been as terrible as what the expectations are. Remember, the expectations going into the analyst expectations from the big Wall Street investment banks going into this earnings season, okay, which is reporting the third quarter. Right? The third quarter, I'm sorry, the fourth quarter of 2015 were extremely low. And the stock market is a expectations game, right? It's future expectations, discounting mechanism. So when expectations are that low, you just got to beat the headline and possibly the bottom line numbers to a certain degree, and your outlook doesn't have to be terrible in order for the stock to make a big pop. All right? That's just the way it works. So when you read those headline numbers, oh, they missed by a penny and the revenues were, slightly above consensus, you know what? And the outlook was kind of lukewarm. The stock still goes higher. You wonder what's going on. Well, that's just the way it works. Let me go back a little bit and show you the volatility cluster that I've posted several times. Bear with me. There we are. And people were a little bit focused. You don't have to be that focused. You just have to basically open your eyes and look at it. I've shown this quite a few times. This is your volatility cluster. This was the crash of August 24th. This was September 29th or so. And this is where we are right now. So the pattern we're undergoing right now here is quite similar to the pattern that we encountered here. So once we get up to about 1950, we could very well have one more of this, similar to this. And then let's see what the market wants to do. By that time, there might be stabilization in the Chinese economy. There might be some good news coming out of Europe. There might be some inflation numbers showing that the U.S. economy is quite, is well on track. And keep in mind, the thing that's driving the market between the dogmatic bears and the dogmatic bulls, remember the dogmatic bulls too, right? Is that the fact that one's calling for a global recession and one's calling, and the dogmatic bulls are like nothing's wrong. There's a middle ground. The U.S. economy, in my opinion, is not in a recession. There are no major recessionary figures that you see. Two reasons. Keep it simple. U.S. consumer spending still strong. Remember, more than 70% of the U.S. GDP is consumer spending. It's you and me going out there getting stuff. So once people lose faith in the U.S. economy and start to decelerate and slow down their spending, you will start to see this market crack. That's not happening yet. If you want to prognosticate and forecast that's going to happen, well, that's your business. I go by what I see in the numbers. Number two, there has never been a global recession, at least historically speaking, with oil prices at historical lows. Recessions happen because there is a supply shock. Oil's up at 100, 120 like it was back in 2007, 2008, $147 a barrel. It causes massive consternation and pain across the board for consumers as well as for corporations, manufacturers. Oil's at barely fighting $30 a barrel. There is a negative side effect, mind you, and we all know that because it's causing a lot of significant pain in the commodity complex, in commodity producing countries. Lots of mid to smaller shale and oil production companies here in the US that are getting blasted. So obviously there is a negative effect on that. But the point is, as in a global recession with oil down at these levels, who knows? It hasn't happened, and I doubt if it's going to happen this time. Let's put it this way. We always think about the market as having a big breakout or a big fallout, right? Well, why don't we think like this? The market's in a trading band. How about that? And working with what we are doing here, we're navigating this market through some of the most difficult times and still producing spectacular results. That's what it's all about. So time to wake up a little bit, because you can sit there and analyze technicals and fundamentals and listening to, and go into your bunkers with a keg and a couple of guns. But the point is that the world is not ending, and there'll always be opportunities in the stock markets, and the U.S. stock markets rule. And I mean that. We have the highest transparency, the deepest liquidity, and we are the best. There's no question about it. And money, when there's a global crisis, money comes here. Some of you might not have traveled outside the US. Some of you might not have seen the world out there. I'll tell you something. We are still the best. Take it from me. So, saying all that, just explain to you. We are in a trading band. That trading band is roughly 1930, 1940, maximum 1950. We'll see what happens after that. Is it possible that we retrace this whole move here? I think that's a very low probability situation. I think we meander around in these volatility circles, move up to the top of the channel. This could be a bear flag. We could get to 1950 and then just basically the bear flag breaks down. We'll see. Whether this happens, I think this is low probability. But a retest of the 34 and the 50 has happened and most probably will happen again. That's all I got to say. Thank you for listening, and get referrals. And please, for God's sakes, study all the great content that I put out there. Have a fantastic trading day, because that's just the way it's starting out. Thank you for listening.